You know how everyone on TikTok and YouTube keeps saying, open a high-yield savings account. It's free money. Yeah, the so-called smart move that gives you 4 or 5% interest while you let your money grow safely. But what if I told you that this is the biggest HYSA trap of modern banking? A trap designed not to grow your wealth, but to keep you quietly broke, while the same banks use your cash to make 10 times what they pay you. This isn't some tinfoil conspiracy. It's a psychological game, a money mindset trick that looks safe, feels smart, but secretly kills your investing psychology. Banks have repackaged old-school savings into a shiny new product and called it high yield. But behind that friendly dashboard and those sleek marketing emails are some of the most effective wealth secrets ever used to control cash flow, your cash flow. Stick around, because by the end of this video, you'll see exactly how the HYSA trap keeps millions of people stuck in the illusion of safety while the rich keep compounding their money elsewhere. And once you see it, you'll never look at your high-yield savings the same way again. All right, let's rewind. How did something meant to help people save turn into a system that quietly steals your potential to build wealth? All right, so here's the thing. People think of high-yield savings accounts like a safety net, but in reality, they're more like a velvet cage. Comfortable, clean, even rewarding, but still a cage. Banks design them with one goal in mind: to keep your money still while they make it move. You see, when you deposit $10,000 into a high-yield savings account, it doesn't sit quietly in a vault somewhere, waiting for you. That money gets loaned out, invested, multiplied, often by the same institutions that preach risk-free saving. And here's the ironic twist. The people who fear losing money end up helping banks make more of it. That's the hidden psychology behind the HYSA trap, a game that looks responsible but quietly favors the house. Banks figured out something about human behavior decades ago. People love the word guaranteed. It soothes our brain. It triggers that safe, warm dopamine hit that tells us you're being smart. And when inflation runs wild and markets feel shaky, that feeling of safety becomes addictive. The idea of getting 5% with zero risk sounds like a dream. But here's the uncomfortable truth. 5% isn't gain, it's recovery. It's you chasing the value that inflation already stole. Let's put it this way. If your HYSA gives you 4.5% and inflation eats 6%, you're not earning. You're paying a quiet 1.5% fee for peace of mind. But it doesn't feel that way, does it? Because the app shows green numbers going up. It looks like progress. And that's where investing psychology gets flipped. The illusion of growth replaces real growth. Now zoom out. The whole system works on this one principle. If you feel safe, you won't move your money. That's gold for banks, because while you watch your savings inch up by a few $100 a year, they're lending your same money at 10%, 12%, even 20% on credit cards and personal loans. That's not just profit, that's margin warfare, and you're on the wrong side of it. Think about the branding too. Notice how banks started calling these high-yield savings accounts only after interest rates went up. Before that, they were just savings accounts. But once inflation spiked and people began looking for better returns, the banks rebranded. They didn't raise interest because they care. They raised it because they had to compete for deposits. Your deposits, because your money is their product. It's wild when you realize that. You're not the customer, you're the supplier. You supply banks with the raw material they need, liquidity, so they can go make real money elsewhere. And what do they give you in return? A thank you note disguised as interest. But it gets deeper. That 4 or 5% interest you see, it's not a gift, it's bait. A calculated move to keep the middle class emotionally attached to safety. The psychology is elegant. Convince people that patience equals progress, and they'll never chase real compounding. The truth is, compounding only works when your money is in motion, not parked. Here's where the money mindset trap gets brutal. Every dollar you park in a HYSA feels like security, but it's actually an anchor. While you're playing defense, the wealthy are playing offense. They understand that money sitting idle isn't protecting them, it's aging. The purchasing power of a dollar doesn't just fade, it evaporates quietly, one price hike at a time. Ever notice how your $100 grocery bill from last year suddenly feels like $130? That's not bad math, that's monetary decay. Yet because your account shows growth in digits, your brain interprets it as winning. It's like watching your treadmill stats go up without realizing you're running in place. That's the HYSA illusion. You feel safe, but safety and stagnation are twins in disguise. Now let's talk numbers, the kind banks don't show in ads. Say you deposit $50,000 into a high-yield savings account at 4.5%. You'll earn around $2,250 in a year. Feels nice, right? But if inflation sits at 5 or 6%, you've already lost purchasing power worth $2,500 to $3,000. You're technically poorer, even though your balance went up. That's the cruel genius of the system, making loss feel like progress. And while you're collecting crumbs, banks are dining on the loaf. They take your $50,000, combine it with 1,000 other deposits, and lend it out as mortgages, auto loans, or credit lines. On that same $50,000, they can generate $200,000 in loans. And each of those loans earns interest far beyond what they pay you. That 4% they give you, it's marketing. The 12% they earn, that's business. Ever wonder why banks advertise savings accounts harder than investment education? Because savings accounts guarantee loyalty. If you're scared of risk, you'll never move your cash to stocks, bonds, or assets that actually grow. You'll stay trapped in the comfort zone, the place where financial institutions want you most. There's a quote floating around in finance circles. Banks pay you for being lazy. It sounds harsh, but it's true. Because every day your money sleeps, theirs wakes up and multiplies. The rich learned this centuries ago. That's why they own assets that move. Stocks, real estate, businesses, not accounts that nap. But here's the plot twist. The HYSA trap isn't just financial. It's psychological conditioning on a mass scale. Think about the emotional cycle. You deposit money, you check your balance daily, you feel good seeing it rise. You get addicted to that little dopamine hit. It's control, comfort, and certainty. But you've been trained to trade opportunity for security. And in that trade, banks win every single time. The average American keeps around 30% of their net worth in cash or cash equivalents. Guess what that means? That's trillions of dollars of sleeping money. Trillions that banks use to fund their investments, not yours. And that's why wealth inequality widens, not because people don't earn, but because they don't move. Even the marketing is crafted to play with your emotions. Notice the colors in HYSA ads: calm blues, friendly greens, words like peace of mind, secure growth, your future. It's not about returns. It's about reassurance. It's therapy disguised as finance. And it works because humans crave predictability. Let's be honest, nobody wants to see red numbers in a volatile market. But that's the cost of growth. The market rewards courage, not comfort. Every wealthy person you admire understands this. Their money isn't safe, it's working. It's sweating in real estate, in equities, in businesses, sometimes losing temporarily but compounding long-term. Banks know most people won't take that leap. They know fear sells better than freedom, so they don't have to outsmart you. They just have to outweight you. And while they wait, your mindset gets molded. You start saying things like, "At least my money's safe." You start thinking of investing as gambling and saving as winning. That's not caution, that's conditioning. And that conditioning is exactly why the poor stay cautious and the rich stay curious. The HYSA trap is the perfect modern instrument for quiet wealth transfer. It doesn't take your money directly, it just steals your velocity. The time your cash spends idle is time you'll never get back. And compounding, the greatest wealth builder in history, doesn't care about comfort. It cares about time and motion. So next time someone brags about earning 5% risk-free, remember what they're really earning: less than zero in real terms. Because after inflation, taxes, and opportunity cost, that high yield turns into low freedom. And here's the kicker most people don't realize. Banks don't even need your deposit to make money anymore. The fractional reserve system allows them to lend far beyond what they actually hold. So the small interest they pay you, it's a PR expense. The real profits come from leverage, derivatives, and credit creation built on top of your psychological comfort. That's why every major bank pushes digital savings products now. They're not after your dollars, they're after your data, your loyalty, your predictability. The more consistent your deposits, the easier it is for them to model lending risks and forecast returns. You've become part of their algorithm, not their client list. And if that sounds cold, it's because it is. Modern banking isn't about trust anymore. It's about attention. Whoever controls how you feel about money controls where you place your money. And the HYSA trap is the perfect emotional leash. So if you're wondering why you're not getting richer, even though you're saving more, this is why. Because the system rewards movement, not maintenance. And the people who understand that play a different game. They use their savings as a launch pad, not a landing zone. They think in terms of investing psychology: not saving satisfaction. They know every dollar sitting still is a dollar slowly dying. The question is, how long are you willing to watch it happen? Now let's peel back another layer of this machine. If the first illusion was safety, the second is generosity. The story banks tell you goes like this. We're paying you more than ever because rates are higher. We're helping you earn sounds noble, right? But here's the reality. They're not giving you more. They're giving you less of what they're making. The difference between what they earn and what they pay you is called the net interest margin. And that's the hidden gear that drives the entire HYSA trap. Let's break that down. Say the bank offers you 4.5% on your high-yield account. Meanwhile, they turn around and lend your money at 10% for mortgages, 14% for small business loans, 20% for credit cards. That gap between 4.5 and 14 isn't small, it's billions in profit. Every time you log in and smile at your $20 interest for the month, they're collecting hundreds off your same balance. It's elegant theft disguised as fairness. And yet, nobody complains because it doesn't feel unfair. The banks know exactly how to design that feeling. They don't sell math, they sell trust. They package comfort as generosity. They give you a dashboard that celebrates tiny wins and never shows you the full scoreboard. You see your balance growing, they see their balance exploding. It's like a casino handing you free chips to keep you at the table. The longer you stay, the more predictable your losses become. Except here, the casino's the bank, and the game never ends. They've figured out how to make people believe they're winning while the house collects everything. Now look at the timing. Every time the Federal Reserve raises rates, banks rush to launch new high-yield accounts. But here's the twist. They only pass on a fraction of the new rate to you. If the Fed hikes by 1%, you might see your savings rate go up by 0.3%. The rest, straight to the bank's profit margin. That's how they quietly fatten earnings while convincing you they're doing you a favor. You'd think competition would fix that more online banks offering 5% would force others to pay more. But even that's a mirage, because most of these different banks are connected behind the scenes through shared liquidity networks or the same parent institutions. They move like rivals but profit like partners. And here's the masterstroke. They've turned saving into content. They know how to weaponize the internet. Influencers brag about earning free money with their HYSA, and suddenly it feels like financial wisdom. You see people on Reddit and YouTube flexing their interest screenshots like badges of honor. That's how money mindset manipulation works in 2025, through social proof. They don't have to convince you directly, they just let your peers do it for them. Meanwhile, inflation keeps doing its quiet job. When prices rise 5%, your 4% interest doesn't just fail to keep up. It hides the fact that you're losing. Imagine a treadmill that tilts forward while you're running. You feel movement, but gravity's winning. That's the modern financial treadmill. And every like, share, and look at my interest earnings post adds one more layer of illusion to the whole system. The cruel part? It's not just the banks winning, it's the entire financial hierarchy feeding on your inaction. When you park your money, the government borrows cheaper. Corporations get easier loans. Markets get liquidity. You become the quiet enabler of everyone else's progress. You fund expansion while staying stagnant. You help move the world's economy while yours barely moves an inch. It's poetic in a dark way. The saver becomes the silent financier of risk takers. The cautious feed the courageous. The people who fear volatility fund those who embrace it. And that's why the rich never keep large amounts in savings. They understand that liquidity has a cost you pay in lost opportunity, compounding, and time. Think about this. If you had kept $10,000 in savings over the last 10 years, earning an average of 1%, that's roughly $1,000 in total interest. But if you'd invested that same money in a basic index fund, earning 8%, you'd have more than doubled it, around $21,000. The difference? Not luck, not timing, just movement. Banks know most people won't take that step because they've been trained to equate volatility with danger. But real investors see volatility as the price of progress. Every dip, every correction, every short-term loss, that's the rent you pay for long-term growth. The bank's mission is to make you allergic to that rent. Let's dig into how deep this conditioning goes. When you open a high-yield savings account, notice how many features they highlight that have nothing to do with actual returns. They emphasize design, simplicity, instant transfers, pretty graphs. They gamify your patience. Each time you see confetti for reaching a savings goal, it's not to celebrate you, it's to train you. You become emotionally attached to saving, not growing. That's behavioral finance 101. And while you're celebrating your milestone, your money is being used elsewhere, sometimes even to finance corporate stock buybacks or high-interest debt products. That means your savings could be indirectly fueling the same corporations whose price increases are crushing your purchasing power. Let that sink in. This is where the wealth secrets of the rich start to look almost unfair. They understand that the goal isn't to save money, it's to move it through systems that multiply it. They park cash briefly for opportunities, then deploy it. They think in yield chains, not yield accounts. And those chains always connect back to assets, things that appreciate while they sleep. Now let's zoom in on the mechanics again. Banks operate on something called the spread. They borrow from you cheap and lend expensive. In fact, if you deposit $1 million, they can create loans worth up to $9 million because of fractional reserve lending. That's leverage powered by your caution. You fear losing 10%, they risk 900%. And that's how they scale wealth exponentially while you settle for incremental. And when people say, well, at least my money's insured, they're technically right. Up to $250,000 per bank by the FDIC. But that's not generosity either. That's confidence insurance. The government can't afford a mass panic, so it guarantees deposits to keep you calm. The system isn't built to protect individuals, it's built to protect stability, and your calmness is part of that design. It's hard to accept that, but this entire setup is psychology dressed as finance. You're told to avoid risk, to save for a rainy day, to hold cash just in case. And those are fine lessons, if the rain ever stops. But in an economy where inflation is constant and compounding is unstoppable, waiting becomes the most expensive decision of all. Now here's something few people ever connect. Banks want you to distrust the market. They quietly benefit from every market crash headline, every stocks or risky viral tweet, because fear pushes money back into savings accounts. That's deposit inflow. And inflow equals capital to leverage. So every time you panic sell your investments and retreat to cash, you're playing right into their rhythm. Even more ironic, when you're saving, they're investing your savings into the same volatile markets you fear. They're buying bonds, equities, and funds with your deposits, earning returns you could have earned yourself. You carry the emotional burden of risk, but they reap the rewards of it. That's not just business, that's brilliance. The deeper you look, the more it feels like the HYSA trap is less about money and more about momentum. Banks discovered that the greatest resource isn't gold or oil or credit, it's human inertia. The less you move, the more they gain. The longer you delay investing, the longer they stay dominant. That's the real compounding, not of cash, but of control. But let's make this real for a second. Imagine two people. One keeps $100,000 in a HYSA, another invests the same in a diversified portfolio averaging 8%. In 10 years, the saver ends up with around $150,000 after compounding. The investor ends up with $215,000. Same starting point, different mindset. The gap isn't just $65,000, it's 10 years of lost acceleration. Because once you miss compounding early, you can't buy it back later. That's what the banks count on. They know people value the feeling of progress over the reality of it. They design everything, rates, dashboards, even marketing copy, to give you that feeling. You don't chase returns if you already feel rewarded. You don't question the system if you feel secure. The HYSA trap works not because it lies, but because it comforts. And comfort, in finance, is the most dangerous currency there is. The truth is, banks don't fear regulation, they fear realization. The moment the average person wakes up to how little a 5% yield really means in an 8% inflation world, the model collapses. People would start moving money into assets, into funds, into anything that compounds faster than inflation. The whole illusion would fracture overnight. That's why they'll keep promoting saving as safety and investing as gambling. It keeps the masses emotionally conservative and financially compliant. Because in the end, the HYSA trap isn't about keeping your money safe. It's about keeping your potential contained. And here's where it gets hauntingly familiar. Just like the bankers in 1914 turned national debts into war profits, today's financial institutions turn your fear into their fuel. Different century, same psychology. You think you're opting out of risk, they're just cashing in on your calm. And here's where the illusion deepens. Because the real trick isn't just making you feel safe, it's making you believe that this safety is the smartest financial decision you can make. When you open your high-yield savings account, the app welcomes you with words like secure, protected, and risk-free. They use language that taps straight into your survival instinct, the same one that tells you not to walk on a cliff or touch fire. Your brain associates risk with danger and saving with safety. But in the world of money, that instinct is often your biggest enemy. You see, banks understand that humans crave certainty more than opportunity, and they've built their entire marketing psychology around that weakness. Think about the way they advertise: a clean interface, pastel colors, calm voices, a promise of peace of mind. It's not an accident. It's designed to make you feel emotionally stable while your money remains financially stagnant. That's what I call emotional engineering, where they calm your fears just enough to stop you from asking deeper questions. Let's zoom out for a second. Imagine you have $10,000 sitting in your HYSA. The bank pays you around 4.5% annual interest. Sounds nice, right? That's $450 a year. But what most people don't realize is that same $10,000 doesn't just sit there. The bank takes it, lends it out, invests it in treasuries, buys assets, or uses it to fund corporate loans. On average, they make anywhere between 8% to 15% annually from that same money. That means your $450 of free money is actually part of a $1,500 profit they quietly earned off your savings. Now here's the part that really stings. When inflation sits at around 4% or even 5%, that high yield instantly becomes a zero-sum game. You think you're earning, but in reality, you're just treading water. Your purchasing power stays the same, or worse, shrinks. So when you celebrate your new interest payout, you're actually cheering for a race you didn't win. Banks understand this psychological blind spot better than anyone, because as long as you feel like you're making progress, you won't look for real growth. And this is why the rich never fall for the HYSA illusion. They know that storing cash in a savings account is like parking a Ferrari in a garage and calling it a road trip. Sure, it's safe, but it's not moving. They understand that money has to move, has to circulate, has to grow faster than inflation to build wealth. That's why they use cash only as a temporary vehicle, a holding tank before deploying it into higher-yielding assets like index funds, businesses, or real estate. The middle class, on the other hand, gets trapped in the comfort of safety. They mistake financial stillness for stability, and in doing so, lose years of compounding growth. But it gets deeper, because the banks have turned this psychological comfort into a billion-dollar industry. Every time you deposit money, you're not just funding their operations, you're helping them build leverage. The more deposits they show, the more credibility they gain with regulators and investors. They then use that trust to borrow at even lower rates. In short, your emotional need for safety becomes their financial weapon for profit. You might wonder, if everyone just saved in HYSA, wouldn't that mean the banks are at risk of paying too much interest? Not quite. Banks are experts in timing the market. When interest rates go up, they push HYSA aggressively to attract deposits. When rates fall, they quietly reduce payouts, knowing most people won't bother to move their money elsewhere. It's the perfect game. They adjust your earnings just enough to keep you loyal, but never rich. And then there's the tax illusion. That 4.5% interest you earn, it's fully taxable as ordinary income. So if you're in a 24% tax bracket, your real return after inflation and taxes might be around 1% or even less. In other words, the system rewards inactivity and punishes growth, all while making you believe you're being financially responsible. This is why the HYSA trap is so powerful. It aligns perfectly with human psychology. It tells you what you want to hear, that safety is smart, that saving equals progress, that patience will eventually pay off. But in reality, patience without growth is stagnation. Your grandparents' generation might have earned 6% to 8% interest when inflation was 2%, but that world doesn't exist anymore. Banks simply rebranded savings into a digital illusion, a feel-good app that keeps your cash where they can use it best. And while your money sits still, the world around it compounds. Assets rise, opportunities multiply, and inflation keeps biting quietly every year. Most people don't realize they're losing wealth not through spending, but through inactivity. Every year your cash sleeps in that account, it loses a little more purchasing power, death by 1,000 decimals. The wealthy understand this invisible decay. That's why they view liquidity differently. They don't keep their emergency fund in HYSA out of faith in the system. They do it out of strategy. It's a parking lot, not a home. They know every dollar left idle is a soldier not fighting for them. And that mindset difference between safe storage and strategic holding is what separates financial security from financial freedom. So the next time a bank ad tells you your money is growing safely, remember, it's not your money that's growing, it's theirs. They've mastered the art of making you proud to stay broke slowly. And once you see that clearly, it's hard to unsee. But this game isn't just about psychology, it's about structure. Because behind every high-yield savings account lies a system built to make banks richer while you feel smarter. And to really understand how deep this goes, we need to look at what your money does the moment it leaves your account. So here's the truth. Your money deserves movement, not safety that sleeps, but strategy that works. Because banks have spent decades perfecting the art of keeping people feeling financially smart while staying financially stuck. If this video opened your eyes, don't just close the app and move on. Move your mindset. Start questioning every safe financial product that sounds too comfortable. Real wealth isn't built by avoiding risk. It's built by understanding it. And if you want more content that exposes the silent money games keeping everyday people from building real wealth, subscribe to Voice of Wealth, because the next video might just show you how to turn the same system that traps most people into one that works for you. Your move.